Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai INT Medical Instruments Co. Limited Annual Report. Shanghai INT Medical Instruments Co. Limited offers a wide range of medical instruments and devices for various applications. At the heart of their product line are cardiovascular interventional medical devices, including digital inflation devices, cardiac valves, balloon inflation catheters, guiding catheters, microcatheters, guidewires, angiography catheters, and Y connector packs. In addition to these core products, the company also provides a variety of accessories and other medical instruments. These include pressure bandages for compression hemostasis, angiography syringes, stopcocks, sterile Seldinger needles, pressure transducers, extension tubes, introducer sets, joint intervention kits, and distal access catheters. Furthermore, Shanghai INT Medical Instruments Co. Limited offers a range of medical accessories such as check valves, needle-free connectors, male lure locks, bistoppers, Heparian caps, flush devices, flow regulators, and drip chamber assemblies. They also manufacture other products like disposable respirators, 3D medical surgical masks, vaginal dilators, Foley catheters, infusion pumps, umbilical cord clamps, infusion connectors, and burette infusion sets. Overall, Shanghai INT Medical Instruments Co. Ltd.'s product line is diverse and extensive, catering to various needs in the medical field. Shanghai INT Medical Instruments Co. Ltd. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Shanghai INT Medical Instruments Co. Ltd. trades at a higher price-to-earnings ratio of 25 times and a higher price-to-book ratio of 2.57 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 21% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Revenue growth in the company is primarily driven by several key factors. Firstly, an increase in new customers has contributed significantly to revenue expansion. Additionally, business combinations have also played a crucial role in driving revenue growth. The sales of interventional medical devices, particularly vascular and non-vascular intervention devices, have seen substantial increases of 25% and 20%, respectively. The normalization of DRG/DIP payment mode, favorable government policies, has also positively impacted revenue growth. Furthermore, the acquisition of Hangzhou Weiqiang has enriched the company's product pipelines and R&D capabilities, leading to increased revenue. The expansion of product layout in peripheral vascular intervention and implantation has also contributed to revenue growth. On the other hand, revenue decline is primarily driven by a decrease in agent business, which has seen a significant drop of 49%. The United States market has also been a primary driver of revenue decline, with a decline of 16.3% compared to previous years. Net income experienced a significant increase between 2024 and 2025, rising by approximately 22%. The net income grew from RM 190.05 million in 2024 to RM 132.67 million in 2025. However, the profit margins showed a different trend. The gross profit margin decreased from 63.11% to 59.77%, indicating a decline in profitability. This decrease was consistent across multiple pages of the summary. On the other hand, the operating profit margin remained steady at 25.3%. Additionally, the net profit margin also saw a slight decrease from 22.2% to 21.7%. The reasons behind these changes are not explicitly stated in the provided text, but it is clear that while net income increased, profitability as measured by gross and net profit margins decreased. The company's debt level has undergone significant changes. The total current liabilities have seen a substantial increase of 86%, rising from RMB 434.46 million to RMB 810.55 million. Furthermore, loans and borrowings have also increased by a notable 128.4% on page 5. Non-current liabilities, specifically loans and borrowings, have risen from RMB 0 to RMB 171,339. The increase in debt has led to significant changes in interest expenses as well. Interest on lease liabilities has seen a 42% rise, while interest on loans and borrowings has skyrocketed by an astonishing 590%. These substantial increases indicate that the company's financial situation is undergoing considerable changes, with potential implications for its future operations and profitability. The performance of various regions and segments within the company has shown significant changes in 2025. On a positive note, the Chinese mainland region saw a notable increase in revenue by 35.3% in 2025. The cardiovascular interventional business also performed well, with an 8.1% increase in revenue from external customers and a 13.6% increase in segment revenue. In contrast, Europe and the United States experienced declines in revenue, with decreases of 16.6% and 16.7%, respectively. The All Others category was particularly affected, with a staggering 133.8% decrease in revenue from external customers and an 86.3% decline in segment revenue. However, it's worth noting that the segment net profit for this category increased by 269.1%. Management is emphasizing a strategic shift towards investing in life science and healthcare sectors, with a focus on equity investments. This includes a concentration on medical devices, pharmaceuticals, biologics, and contract research organization, services industries primarily in the People's Republic of China, PRC, through various funds. The company is prioritizing venture investment in startups or early-stage businesses within the medical devices industry. This move aims to facilitate strategic development and enhance competitiveness in the healthcare and biotechnology sectors through targeted investments. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which have been proposed for the year 2025 at RMB 0.23 per ordinary share. This move demonstrates the company's commitment to sharing its profits with its investors. In addition to dividend payments, the company has also engaged in share buybacks. Notably, this practice has been a consistent feature of the company's financial strategy, with share buybacks recorded for both 2025 and 2024. By buying back shares, the company aims to boost shareholder value and potentially increase its stock price. That concludes the financial summary for Shanghai INT Medical Instruments Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.